ISM manufacturing data out earlier this morning, coming in below expectations at 46.5, under the average estimate of 47.6, its sharpest contraction this year. The data showing further signs of weakening as the election and Fed policy spook businesses. Joining us now to break it all down, we want to bring in Tim Fiore, chairman of the ISM Manufacturing Business Survey Committee. Tim, it's great to have you here. So when you take a look at these numbers, manufacturing sector now contracting in October for the seventh month in a row. I'm curious just to get your reaction and what you're hearing from business owners.
Okay, thanks, Seana. So that's 7 months. 7 months ago, we had a PMI of about 50.3. So if you really look at it, we're 26 months into a contracting manufacturing environment, primarily driven by the new order levels of demand being non-existent for 26 months. Our backlogs at 25-month contracting declines. So we don't have an order book anymore. The order book has all been used up. The soft landing has allowed us to consume all that excess ordering and excess inventory over the last couple of years, but we're waiting for demand to come back. As a result of demand not coming back, we're taking steps on the output side, which is really defined as production and employment. And as you can see, that's really the story for the month, is that our production number, which is really a surrogate for revenue, is down to 46.2, lowest level in several years. Not a huge surprise. We've been projecting this now since May. The extent of the number is a little bit surprising, but not totally surprising. You also have the hurricane factor in there. So we're in a destaffing, declining output environment here, and we think we'll stay there probably until sometime in Q1 of next year.
Yeah, Tim, I was going to ask how long you see that being the case. I guess given some of that weakness that you have seen, how much of this has to do with uncertainty surrounding the election?
Well, a lot. So leading up to the Fed announcing that they're on the rate reduction profile, the single biggest issue was what's happening with rates. We're waiting for rates. I mean, we've been waiting for rate reductions since back in March and April of this year. And as we started 24, that was the belief that we would see rate reductions happening in Q1. So it's now Q4, and we're seeing those. But at the time that they finally announced that we're on a declining environment for rates, the election was right on us. And right now, the feeling is from the community, and this came through pretty strong in the comments, is that both candidates are proposing inflationary fiscal policies, which is going to make the Federal Reserve's monetary policies much harder to implement. So in other words, the Federal Reserve's Jay Powell is going to be wrestling with the tiger all the way through the first half of next year. And there's a bit of uncertainty there. So I think we've been saying that we're not going to see demand come back until Q1 of next year. It may not be until February, March, when whoever the winner is has announced their implementation plans. And if we have a divided Congress, is going to make a huge difference. So a lot of uncertainty still here. We're going to have to wait to see what happens in Q1, I think. The election will be a big indicator, but honestly, with the tariff policies on one and tax cuts, and then you have the spending policies and the green energy issues on the other, both of them are inflationary, and it's going to be hard to keep that 2% PCE core target at where the Fed wants it to be.
So, Tim, that's interesting. And then I guess marrying that with what you were just saying, just in terms of it won't be until Q1 until we start to see any sort of improvement. It doesn't sound like we're going to see much improvement then.
Well, I think this grow out is going to be slow. If it's not slow, it's going to be inflationary. So there's no reason why it wouldn't be slow. There's no reason why that, after post-pandemic, we've cleared all that mess and all those first-time events and record-setting declines and record-setting growth. We should be back in a normal supply-demand environment here, and there shouldn't be a lot of pent-up demand. That should all have been kind of satisfied. So we should be on a 1.7 to 2.0 GDP growth profile. So, and that will look a lot like what we saw back in 2016 through 2019, which was a slow but steady, and then it started to accelerate a little bit after the Tax Cuts and Job Act had some impact. And so there's no real reason why this is going to be a 3 or 4% growth. I mean, we should be back on our 2% profile. And as a result, we're going to see probably most of 2025 seeing a 52 to 55 PMI number. I don't see why we wouldn't, unless global issues like a huge investment in infrastructure for defense equipment and all that comes to play. I don't see why we would have a hot grow out period.
Tim, looking at the five sectors or five manufacturing industries that did report growth, among them you had apparel, you had food and beverage, you also had computer and electronic products. What are you hearing from those businesses, communities, just in terms of the overall environment? And do they expect maybe some of that strength, if you want to call that, or at least some of that growth that we have seen, can that continue in this uncertain environment?
Sure. So two of those are in our big six. The big six industry sectors represent 73% of manufacturing GDP output. So I focus a lot on the big six. Food and beverage is our number one big six performer for the last 3 months, but it's a seasonal area, and we seasonally adjust at the top level. We don't do it at the industry level. So I would expect, and if you look at the profiles over the last few years, food and beverage starts to fall off in November. So I think the food and beverage support is going to fall off in November. What's going to replace it? Well, computer electronics is expanding, but it's not expanding really strongly. There's a belief that some of that could be AI, maybe. Some of that could be a PC refresh cycle, probably. But again, it's not expanding at a 56 or 57 on its own merit. It's expanding at a 52, 53. So what we really need is we need transportation equipment to come back. That's contracting at a low 40 level, which is dangerous. That's automotive, it's aerospace, it's rail, truck, boats. So, and right now the automotive is the biggest headwind because of the huge amount of inventory and the pricing versus affordability versus leasing / interest rate activity that we're trying to fight through, and we will. With Boeing, hopefully the Boeing strike will end on Monday or Tuesday, and that'll clear up Boeing so that a year and a half from now, hopefully they'll be performing at a much higher level. But that's kind of where we're at. Food and beverage is holding us up. It's not going to hold us up for long. Computer electronics is helping for sure. That's a good thing. It's number 4 of the big six. But we really need transportation equipment to come back. And on top of that, chemicals is our number one industry sector, about 19% of manufacturing GDP. And we've been contracting on a pretty steady profile. It's also a feeder industry sector that supports the other 17. So when you see chemicals kind of turn around and get back up to 50 at 52, then the other industries are actually performing better. So that's a complicated answer, but that's kind of where we're at. Samantha, food and beverage, good, not for long. Computer electronics will probably stay at a fairly low expansion level. We need transportation equipment to come back, probably not until Q1. And our chemical area and our fabricated metal products, both in the big six, are still contracting. And those are feeders for the other 17. And we were not expecting those to really start to expand again until Q1 of next year.
All right, Tim Fiore, it's great to have you, especially on a day like today. Thanks so much for taking the time to join us.